All right. Well, thank you everybody for coming. And we've got a exciting for us speaker lined up here. Our old friend Mario Nardone. I've known Mario for I don't know 6 years or so at this point, and I met Mario at a conference where he was answering questions on investment philosophy, and I sat down and asked him a question that had been bugging me, and I can't remember what the specific question was, but his answer was along the lines of, you're overcomplicating things, you're overthinking things, simplify it, your clients will like it and be fine. And he was absolutely right. And I was like, you know what? This is the guy for me. So Mario started his career in 1999 with Vanguard. And everybody knows and Vanguard, and we use Vanguard quite a bit. And it's been a chartered financial analyst since 2003. That's the designation that I kind of look at it as, the CFP is great, but the CFA is way too much math for me. So I always have a lot of respect for those folks that can do that. Mario lives in Charleston. He's the chief investment officer of East Bay Investment Solutions. We've been working with Mario for a little over a year. He helped us develop our new and improved investment philosophy, and then has kind of taken over due diligence and helping us build our models and keep them in line for folks. So, Mario?
Yeah, thanks, Dave. And I will, sort of
Fill in the blanks.
Caveat a little bit of what you said. Just to give you a little bit more background, we work with great financial planners like Dave and Nick and the team to support them from an investment perspective. My business partner and I are, sort of an inch wide, mile deep on investments, whereas a comprehensive planner like those that you work with have all of your bases covered. Insurance, retirement planning, estate planning, investments are just one component of it. So we love the opportunity to support the broader planning process. We love working with folks with the demeanor of Dave and Nick, and it's great to be in front of you guys today. I hope to meet you in person or see your faces on this call. I could see your names. Please don't be shy. If just left to my own voice, this could be a pretty quick call, but we want to make sure it's gets you what you need from it. So if you have any questions in particular that I don't touch, or even up front that you want to make sure we hit, I'm happy to do that. So
Nick and I will keep an eye on the chat and the questions and answers as they come in. So folks, if you have questions for Mario, type them up, send them in, and we will make sure they get addressed.
Sounds great. Yeah, I can keep that window up as well, but it might be better if you guys just give me the old hook if I miss it and we need to stop on something. So with that, why don't I share my screen? You don't really need to see my face to know what's going on and get the most out of this. So I'm going to turn off the video, at least until the end, and that'll save my internet bandwidth as well. So, okay, getting started. So this is something that we put together every quarter. We do the most recent quarter in review, and we do take a look at where we're at in the cycle, what's the current environment, what's the outlook. But I want to make sure to say up front something that Dave and Nick probably talk about all the time is our investment philosophy is not predicated on prediction. We're going to talk a little bit about it. We're going to poke fun at the folly of prediction in the presentation. We don't even bother with that. That being said, we need to know where we are. We need to know a little bit about where we're going, just to have an idea of why our portfolios have behaved, are behaving, or might behave going forward. And if there are opportunities to make adjustments, whether it's at the individualized level, because all of you do have very personalized plans with the firm, with your planner, or broadly in the model portfolios. We're always keeping an eye on things, as well as investment options that could be tailored to meet your investment goals and ultimately your financial planning goals. So again, it's a review of the fourth quarter, and in this case, the entire calendar year 2022, and also just something to keep perspective on the current and future expected environments. we always like to start our conversation by taking a balanced approach. Some of you might be, looking at the environment and your portfolios with a glass half empty mindset. Some of you are looking with a glass half full. Just realized that my presentation is going to run away from me, so let me change that. It's going to automatically advance if I don't change the settings. So let me just reset. Sorry about that, folks.
Didn't even know that was something you could do, Mario.
What, mess up on the technology? Of course, that's
Automatic
something.
advancing on PowerPoint. I learned something new today.
Yeah, that's the default, and I forgot to change it. So anyway, we think that the attitude coming into our investments should be somewhere in the middle. We don't want to be overly optimistic. That can lead to over exuberance and bad decisions, and negativity can lead to bad decisions and just a general poor outlook on the future. So there's reasons to think about both sides of it, and I'll focus on the right side of the page, which would be the reasons for concern. And please tell me you can see my screen again, right? Can't hear David.
It hasn't come back up yet.
Okay,
There you go.
here we go. All right.
we
Hopefully
are.
no demerits for technology here.
No.
The right side of your screen, again, are the reasons for concern or maybe hesitation about the current environment. We'll talk about these things in detail as we go through the slides, but ultimately the first thing is that inflation is still stubbornly high around the world. This is not just a US based problem. The second thing, questions about whether or not we are in or facing a recession. And then lastly, China has had a zero COVID policy that has really put a damper on supply chains and just the global economy because of how intertwined most manufacturing is with China. So that's been an issue. And then as they relax those policies, how is COVID going to impact their economy, their population, and how does that flow into the global economy in reverse, right? After these policies are released. Then certainly there's the humanitarian crisis in Ukraine, which is still dragging on. Who knows when that's going to end, but certainly something that is terrible to watch for a lot of reasons, but also has an impact economically. On the bright side, the left side of your screen, at least here in the US, inflation has been coming down for a few months. The third bullet point there, jumping ahead, is in general, we're still seeing very strong economic data, including and especially in the labor market, which is a very important factor when thinking about, what is a recession. A strong labor market broadly means that our economy will likely be able to weather the technical definition of a recession. Obviously, people that are not, on the favorable side of the labor market feel things a bit differently, and we're not trying to be unsensitive to that. But broadly speaking, from an economic sense, strong labor force and other data, which we'll talk about, certainly bodes well for the recession scenario. And then the middle bullet is better off displayed a little bit humorously on, oh man, I'm using the wrong slide deck in general. Let's just go with what the slides say. What you'll see in a few slides is that one of the most positive aspects for us as an investor is that we are now expecting a better rate of return from our bond portfolio. Bonds have been out of favor going into, for a long time, going into the beginning of last year with very low yields. But with the negative situation that we've seen in the bond market, we actually can expect a better rate of return on that part of our portfolio going forward. But what you're looking at on the page here is not necessarily about the bond market. It's a very busy page. We're certainly not going to talk about every single data point, but it's going to be very helpful to talk about inflation and how to make sense of the information that you are going to be seeing when you read the financial media, watch the news, and you might have a little bit more insight when you see and hear these numbers. So the top two rows represent the most common inflation number that you're going to see. And in particular, at the far right, you see the most recently published inflation number, which is as of December. It always comes out as a lag, right? So it's not stale data. This is pretty up to the minute. But what you're looking at there is the year-over-year inflation number, the percentage change in the price of a basket of goods that are very typical for an American consumer. But year-over-year means this is the difference between the most recent December level and December of 2021. And that's a good number if that's what you're trying to measure. But the problem is it doesn't really tell you a lot about what's happening with inflation right now, right? The increase of 6.4% could have predominantly come in the earliest months of that measurement period. So you have to take that year-over-year number with a little bit of a grain of salt. And unfortunately, that's the one that gets published the most. But the third and fourth row, which are outlined in the second box down, show you the more recent month-over-month number. So if you look at the December numbers month over month, you see that inflation represented by green, which is good, versus red, which is bad, and yellow somewhere in between. You see that the month over month numbers actually indicate that more recently inflation is looking pretty good. And in fact, it is the case that the higher inflation months were earlier in the period, and they're baking themselves into that year over year number. So keep that in mind, that year over year doesn't tell you the story. And then another way to look into it, that to make sure you're getting the whole story, is essentially the bulk of the rest of this page. And instead of looking at each number, I would just look at the pockets of red. And if you go from left to right, you see that the first pocket of pocket of red is in the goods categories. So this was really, beginning of last year, we were looking at, this was still supply chain disruptions from China. The vehicles, especially used cars, we heard a lot of conversation and headlines about microchips and shortages and things like that. So things were a lot more expensive, and not to mention the pent-up demand from COVID and stay at home and everybody doing renovations and appliance repairs instead of taking vacations and things like that. So, and that's the beginning of 2021. As you shift to the right, the middle to the top part of the grid, you see inflation flowing into the energy and food categories. And that coincided pretty, highly with the Ukraine situation. We know that Ukraine and Russia are big exporters of food, especially grains. Russian oil is Russia is a big supplier of oil. So we saw inflation in those components. Those have since subsided as you move to the right. And now at the bottom right, we're seeing a very big component of inflation is in housing costs, in particular rental prices. So those prices tend to be sticky. Home affordability costs in general are all what is currently keeping inflation high. That is very localized, very individualized number. So just keep in mind that, yes, we may be seeing inflation in various parts of our economy. They may or may not be affecting each of us equally. And when rental costs and other housing costs start coming back down, that may actually be the time when inflation in general starts declining. I know I spent a lot of time on that slide. I promise we're not going to spend that much time on all the slides. This one looks very similar, but instead of just looking at the US, this is global. So if you look down the left side of the page, you see various economies, various countries and regions. What we're really trying to say is that inflation is not just a US phenomenon. If you look at the far right, you see a lot of red. The one notable exception is that China's inflation rate is under 2%. Again, a lot of that has to do with the COVID lockdowns and its dampening impact on their economy. That is going to be, yet to be seen how that will change once they really do start unleashing their economic potential. Everything okay so far, Nick, Dave? Any course correction here? Questions that need answering? I'll take that as a no. Okay,
Doing great,
so
Michael.
what's that?
Doing great.
All right, awesome. So you hear a lot about the Fed. Every newspaper and news source talks about the Fed almost on a daily basis right now. Yes, the Fed has some influence over inflation here in the U.S. It has the option to increase or decrease demand for goods and services. Has a little bit less influence over the supply of goods and services. So they're doing what they can to make sure the demand side is balanced out and trying to keep a strong labor force while taming inflation. The supply side, whether it's China, Ukraine, that sort of thing, that's going to have a big influence on how it all plays out. But basically what this slide is showing is essentially the aggregate rate increases or decreases by the Fed and its contemporary federal central banks, essentially, of 9 other regions and countries around the world. So if you look at the far right, you see that the US and other central banks have had a unanimous, concerted effort to raise interest rates in an effort to dampen demand and keep inflation down. The last time there was this much consensus and central banks moving in the same direction was in 2008, although it was in the opposite direction. This was after the financial crisis. The Fed and its contemporary elsewhere were all trying to lower rates, lower the cost of capital to try to keep the economy going and get it kickstarted back again after the financial crisis. But those are the 2 recent events that really show that these are global phenomenon and things that not just the US, but other government entities need to resolve as well. This looks like a pretty basic slide. So it looks like 3 buttons, coincides or should, basically is a graphical representation of the operative phrase of pace, pause, and pivot. And that's what the Fed is talking about and what everybody is trying to ascertain of what the Fed's going to do. How fast are they raising rates and when are they going to slow? When are they going to stop raising rates? The pause. And then the pivot is when do they start reducing rates? So on the left, we see the pace. The pace of rate increases last year was among the fastest on record. It's hard to really, there's not really one way to say faster or farther, but since the 80s, it's definitely up there with one of the fastest on record. Although at the end of the year, the Fed raised rates by 50 basis points after doing so by 75 basis points the previous 2 times. So at least it looks like the pace has or is slowing. It may be a little too early to determine when the pause will happen. And even the different Federal Reserve governors have a different outlook on when they think they'll stop raising rates. And that just means the question about when they will pivot is not even, way too early to call that. The question is really, at what point does the Fed just stop and see what happens before feeling like they need to reverse course and stimulate the economy again? And that's so far off, we probably don't even need to talk about it. I see a question in the Q&A. I'll just handle that now. I was able to see that pop up. So the question is the wrangling over the debt ceiling, political stonewalling and potential default and its impact on the economic recovery. Great question. This question was not being discussed when, even a week or 2 ago, right? But now it's hot, it's front and center. So we don't really get political. This conversation can get political pretty quickly, but this isn't the first time that we've seen this debate over the debt ceiling. The takeaway from our perspective is that we've been through this before. Regardless of the rhetoric, we know that our government does not want to see the U.S. default on its debt. In the past, there's been brinksmanship, but we've always come to a resolution. From a practical perspective, we think our deficits, the country's debt should get reined in. I need to keep a budget. You need to keep a budget. Dave and Nick, make sure you keep your budget, right? or do the best they can. Country needs to maintain a budget as well. That being said, I know I'm being recorded and we don't make predictions, but it's very unlikely the US will default on its debt. We've been to similar situations before where the US was downgraded from essentially a perfect credit score among bond issuers. And that did not have one bit of impact on the demand for our securities. It didn't have an impact on the value of the US dollar. And given where China is and where the euro is and the pound, I mean, the UK is already in a recession, maybe coming out of it, I don't know. And certainly cryptocurrency not going to displace the US dollar anytime soon. And there aren't many safe investments or assets that will replace US Treasuries. So I don't know if I answered your question directly. I don't think the debt ceiling debate is going to be the unraveling of our economy, treasuries, or the dollar. If I didn't answer your question, let's follow up with that on a second call, or have Dave and Nick clarify that for me. All right, so that's the Fed. No pivot anytime soon. And now we talk about, on this slide, what is the definition of a recession? Some folks, the shorthand is two consecutive quarters of economic contraction. And we had that, right? We know that we had 2 consecutive quarters, but yet that's not the true definition of recession. This is the National Bureau of Economic Analysis are the ones that are the official determiners of whether or not we had a recession. And here are the data points that they use. If you look at the red column, so sort of in the middle of your page there, you see that all 6 of these economic indicators were showing recession. This was in the early days of COVID, the US shut down. Clearly, that was a textbook definition of a recession. Look at the far right, you see very little in the line of orange and red, and much more greens and yellows, indicating that the true factors determining a recession are just not here yet. So is it imminent? Can't say that. Is it definitely not going to happen? Can't say that either. But to preempt any further questions, the one thing that we want to make sure you're aware of is that the economy is not the market, right? You can have positive returning investments in an economic downturn. And the reason for that is because markets are forward-looking. If right now, and I have a slide, if we have time for it, happy to show it or share it. The idea is that if you're feeling down about the economy and your sentiment is down, then that means it's likely that other investors are feeling the same way as well. And the collective crowd is going to reflect those beliefs in their behavior in investments. And it's really easy to get caught up in that and follow the crowd and potentially want to sell your investments and wait till rosier times, sunnier days, if whatever you want to say. But in reality, that's the counter to what we should be doing, because it's when people feel the gloomiest is when it's the anticipation of the bad event finding its way into asset prices. So if you can see through that and recognize the market is pricing in the forward expectations of a recession or doom and gloom, then you'll be rewarded because those prices are already artificially low. And the idea of investing is buy low and sell high. So I know that question wasn't asked, but it may be on your mind, so I thought I'd go there. Now, to poke fun at people that make predictions. These are some pretty well-known names. It's not everybody. I can assure you we didn't cherry pick, right? This is just an article that we saw that, picked out these firms that made a prediction at the beginning of 22 of where they thought the S&P 500 would be. So at the beginning of last year, the S&P was at 4766. This is where these firms expected to end the year. And as you can see in the middle column, only 2 out of these 6 firms even predicted that the market would be down, let alone down by as much as it was last year. Right. So 4 out of 6 very well respected firms, and quite, ones that you see on the headlines, front page of the Wall Street Journal all the time. And even their, eggheads like me and their PhDs and academics that work on this all year long didn't even get the direction right. And if you look at the right side of the page, you can see how, the magnitude of how off they were in either direction, being in double digits. So, basing an investment decision on these, and this is consistent. We do this every year and there's always similar results. So the exercise of making this prediction might be fun, but the fact that you can be very wrong, and typically are very wrong, means it's not a real great way to try to invest your hard-earned capital.
Mario, I looked around last week for the apologies from some of those folks, and I couldn't find them.
Right. No, that's a great point. It's, you guys are sports fans. It's kind of similar to, leading up to Saturday or Sunday, everybody seems to know exactly what's going to happen in the game. But then on Monday, you never hear them replaying their own predictions of how it was going to play out. And they're just saying, well, now we're on to the next thing. They're making their predictions for 2023 in a smoke and mirror trick. But yeah, I think if I invested my money alongside those predictions, I'd probably be wanting an apology as well. So now we're well into the conversation. Let's start talking about the actual performance of our investments last year. Again, a busy page. Focus on the right side of your page first. That's essentially the entire year, 2022. And we're looking at bonds here, right? We're not used to seeing bars pointing downward for an entire year in our bond portfolio. And that does tell you just how unique of a year that was. Within bonds, these are different categories. You have treasuries, you have corporate bonds, municipals. There was really nowhere to hide in the bond market. There was, some did worse than others. Corporate bonds did the worst, mostly because of investor sentiment being what it was last year. Longer term bonds did worse than shorter term bonds. But ultimately, no matter what you did, even in very safe municipal bonds, it was hard to not have a negative return of your bond portfolio. And that has a lot to do, almost entirely to do, with how fast the Fed raised rates last year, because bonds were yielding a very low amount at the beginning of last year. Rates come up very quickly. That means new bonds have higher yields. That means the old bonds are less attractive. Their price goes down. That is bond physics, if you will. It's really math, but it's very similar to physics. And on a going forward basis, because we got these negative returns, it means that all of our bonds, both the existing ones and new ones, are now priced to yield approximately the same going forward, which is more in the 5 or 6% range. So we took our hits last year, but we're set to do a lot better going forward. And that's a trade-off that I would rather take. I'd rather earn, get a negative 12 and then get positive 5 every year after that than just suffer with 2 or 3 year over year over year over year. It's a bitter pill, but it is ultimately better for us in the long run. The left side of the page shows you the fourth quarter, a little bit more positive, or at least it was positive, made up a little bit of that lost ground earlier in the year, but by far not enough to bring bond returns into the positive territory for the entire year. For comparison purposes, this is essentially every column here is a calendar year return for the US bond market. And it's arranged from the worst year on the left to the best year on the right. Clearly, last year was the worst year since 1980 that we've seen from the bond market. And in fact, there's only been 5 negative years where bonds were 5 years where bonds were negative in that time frame, and 2 out of those 5 were the last 2 years. So bond physics tell us that it's very improbable that we would get negative returns going, from where we sit today going forward because of where yields were or where yields are. It's not impossible, but it's very improbable. So I think that the bloodbath is over, and we should see that part of our portfolio adding incremental returns going forward. And here's the slide I was looking for earlier, bonds being fashionable. Somebody told me this is a quote from Zoolander. I am not, it's an old movie. I don't know if I saw it, didn't remember it or whatever, but the point is bonds are fashionable again versus being the, being somewhat avoided last year. Investors were often looking for some other source of yield, something to temper their volatility in their portfolio. We defended our position on bonds. We think it was still appropriate to have that position. The Fed's movements were unpredicted by anybody. And like I said, as soon, going forward, we shouldn't have to worry about another year like we had last year.
Mario, there's a headline in the Wall Street Journal today. I didn't get to read the article yet, but it was along the lines of the new 60-40 portfolio isn't 60% stocks, it'll be 60% bonds.
Wow. Okay. So the inverse of what we're used to.
The normal, kind of the normal portfolio.
That's interesting.
Yeah. I haven't read it yet, but it's on my list.
Yeah, well, that's a creative way to get people's attention, right? But it's not too far from the truth. I think if it's debatable, where we are in stocks right now. Is there, with fixed income, as long as you hold it to maturity and there's no default, you can be getting 5 or 6% from fixed income. You can get even better than that on a tax equivalent basis from munis. So if you can get 7% from munis, now there's a lot of trade-offs. I don't want your phone to start blowing up like, should I be in just bonds? But the question is, with stocks, you're still subject to the animal instincts of the market and behavioral biases. There's nothing equivalent to a bond yield in the stock market. So it's understandable that people are saying, all right, well, I'm okay getting 7% from my fixed income investments versus where we were last year. And maybe I don't need to take as much risk from stocks as long as I'm getting that from the more conservative side of the portfolio. We don't espouse that. We know that stock returns come in chunks, right? So if you decided to switch based on relative, relationships today, and we end up with a positive 20% return from stocks and you missed it, we try to advise against that approach to investing. But if you can achieve your long-term goals by being more conservative, that's certainly an appropriate thing to think about.
Mario, I just want to take 2 seconds, just anticipating some thoughts in the audience. Where we talk about bonds being down last year, and then you talk about 5% going forward. There's a difference, just in a nutshell, between prices on bonds, which we saw drop, and the income component of bonds, which is the yields that would then be higher going forward. So
thank you, David. Yeah. I apologize for skirting over that.
That's when you talk to clients all the time, you anticipate those things.
No, absolutely. Thank you. Yep. Price is down. That means the income goes up. Similarly, this page here, right? Let's belabor this point a little bit more. Fixed income looks good going forward. This is, we espouse a global approach to all of our investments. This shows you, the blue dots show you where each of these countries' bonds yields were at the end of 21, right? Beginning of last year. And then the top of the bar shows you where those yields are today. So in our diversified portfolio, instead of getting a 1% average return, the range is 2.5% to almost 5%. So yeah, to get there, we needed a little bit of a reset in price, but as long as the bonds don't default, we'll get our par value back at maturity and we'll get a higher yield going forward. Now, this is the stock market, similar layout. On the right side, you see calendar year 22, lots of negative for the US stock market. These charts break it down based on the company size, right? Large, mid, and small. In this case, it's just large and small. And then by style of investing, right? You have growth investing and you have value investing. The gray and green bars represent growth. That basically is the premise that you buy a company's stock based on their possible profitability well into the future. A company that might not even be profitable today, but has a high prospects for growth. Versus value, you might have more traditional companies, those that are profitable today, more established, that happen to be trading at a discount to fair value. Growth stocks, sorry for this, attempt at education of what's going on here, but very much in line with us knowing the environment and observing whether our portfolio is behaving and expected to behave appropriately. So it's no surprise that growth stocks took it on the chin, the worst last year, because if you have high and rising interest rates, that means that the farther off your profitability is into the future, the more those future profits have to be discounted or translated back into today's dollars. So at a higher interest rate, those future earnings are worth a lot less. And that's why we saw growth stocks come down this year versus value stocks, which are the yellow and dark blue lines, bars, hadn't fallen as much because they tend to weather higher interest rates a lot better because their cash flows are more in the present. These stocks tend to either pay dividends or close to paying dividends, or at least have solid balance sheets. They just tend, maybe trading at a low price relative to those factors. So right side of the page shows the challenges of last year, despite the left side of your page seeing that some of those returns were clawed back in the fourth quarter. Sentiment changed. The Fed started making, signs that they were possibly going to slow down their interest rate increases, signs that the economy was doing better, and just general improvement in sentiment. But again, not enough to bring stock returns into the black. Looking at US stocks a little bit differently, instead of size and style, this slide breaks it down by sector. So at the bottom of the page, you see the worst performing sectors. This dovetails with the growth comments. You see at the very bottom, technology was the worst performing sector at -8%. The third from the bottom, telecom, communication services down 4%. Consumer discretionary is sort of a mixed bag, but obviously the kinds of things, luxury goods and whatnot, that we don't tend to buy when we're worried about our future economic prospects. Some of those stocks are growth, some are value, but ultimately the bottom 3 are dovetail, for the use, sorry for the overuse of that term, with the underperformance in growth. At the top of the page, you see sectors that are traditionally value oriented, 2 of them being flat, utilities and staples being goods that you're going to buy regardless of the economy, household goods and that sort of thing, toothpaste, and then energy stocks at the top. Now, that's not just a value growth story. The war in Ukraine, as I mentioned earlier, put a crimp in global energy markets that had a increasing effect on prices. And when oil prices and gas prices go up, that tends to improve the profit margins of energy stocks. And stocks certainly saw a little bit of a boost earlier this year, although it's really nothing to write home about once you settle it up for the entire year, only returning 1.7%. I promise we're getting close to the end of the slides, unless there's other questions or Dave or Nick want to extend the conversation. But here we show the returns for non-US stocks. Again, we believe in having a diversified portfolio. On the right side of the screen, you see instead of value and growth, we're just breaking it down by blue being international large companies. The orangish one is international small cap companies. Then you have emerging markets and frontier markets. The real story here is that non-US investments broadly helped our portfolio because they hadn't fallen as much as US stocks. Part of that has to do with the impact of the change in the value of the dollar. And this is another slide that hopefully helps understand the different dynamics and components in investment returns. But if you look at the bottom slide here, you see the change in the value of the US dollar versus other currencies in the fourth quarter. So from left to right, you generally see a downward trend of the US dollar versus all the other currencies of the world. Now, that is not good for us as consumers, right? If our dollar is weaker, it means it buys less of the stuff that we want to buy from China and the rest of the world. But as an investor in non-US assets, it's actually a good thing, because imagine at the beginning of the period, we own US dollars, but by buying non-US assets, we're basically giving away those dollars in exchange for the foreign currency, buying the foreign asset. And that, therefore, by owning an asset denominated in a foreign currency, when the dollar falls, that's beneficial to us because we did not own dollars. So that's one of the major advantages. There's diversification benefits, all, traditional investment premises for having non-US assets. But what we often don't talk about is that as dollar-based consumers, we should have assets that are denominated in non-dollars in order to hedge our purchasing power, unless we're going to go to a world where we're only producing and buying things made in the US. And while that could be a good thing for a lot of reasons and a lot of people in a lot of places, it's a very unlikely scenario. That's one of the reasons why you'll always see international investments in your portfolio. The top part of the graph shows you a more extended history going back to 2001-ish. You see the first decade of that period, there was a decline in the US dollar. That was great for international investments. If you looked at your portfolio in 2011, you probably only wanted international investments. But the period since then, with a steady increase in the value of the dollar, that has certainly been a headwind for international investments. And it's gotten a lot of people to ask about the validity of that investment. And we're just here to say this stuff always goes in cycles. Countries and regions go through their ups and downs. We're not here to predict when that's going to turn around, but we're going to own everything. We're going to be diversified by region, by currency. And when one of them is working well, Dave and Nick and the team are going to rebalance your portfolios from what's working well. We're going to take some of those profits and redeploy that into what's out of favor in a systematic way of buying low and selling high. And that's really the end of the presentation. I know this was all about investments, but I am the first investment guy to tell you that investments are not the end all be all that's going to make or break your financial plan. It's the things on this page that you can control, that Dave and Nick can help you help provide guidelines and guidance around. We're here to help investments support the process. Hopefully you got a sense that we know a little bit about what we're talking about, if it's not about PowerPoint slide presentations. My apologies for those trip ups early on, but I'll stop sharing my screen, kick it back to Dave and Nick. And if there's any additional questions or discussion, I'm happy to support it as long as you want.
Not seeing any new questions come in, but we can give it a minute. I had a couple and then we covered them. So
mental telepathy. I don't have a certificate for that, but it is something I've been working on. The only person it doesn't work for is my wife. I just can't seem to crack that code.
Yeah. If you
So
can do that, we'll start a new career.
while we're waiting for questions, Mario, I guess I have a couple of things. I don't know if it's a question or not, but with obviously we can't predict what the Fed's going to do, but you just maybe give us an overview of like what they're looking for, what they want to see happen to kind of slow down, and where we are and where they want us to be as much as you can right now.
Yeah. Your guess is as good as mine. And you know what? Some of it is instinctive, right? It's not, they can talk, we can see all the data that they see. And I thought about this analogy, and it's actually not even great coming from me because I don't have a lot of experience here. But if you've ever driven a boat, if you've ever steered a boat, I think the Fed's job is a lot like that, where you know you have to go over here, so you turn the wheel, right? But if you hold that position too long, it takes a while for the boat to start moving. And before you know it, you've overcorrected, right? And it's kind of like that. You have to have that feel. And Jay Powell and his team probably are there because they have a better feel for things than anybody else, I would hope, right? But it's challenging. And I think what's really challenging is there's a political angle to it, right? Because there's pressure to keep the economy going versus potentially having a recession. They're supposed to be independent, but there's always going to be pressure. And then there's all these other outside influences. So it's like driving a boat with, in a hurricane, right? Because you have the Ukraine, you have China, you have COVID still, and who knows what else, we have winter weather causing all kinds of stuff that California is what, the fourth or fifth biggest economy in the world all by itself.
Mm-hmm.
So there's so many variables. But I think that they're being very transparent. That's something that it was really untrue before Ben Bernanke, right? The idea is let's become more and more transparent so that the market knows well in advance what our intent is. So they're signaling what they're going to do to try to prevent a lot of surprises.
Mm-hmm.
So again, I know that's not really an answer, but they're trying to keep the labor market somewhat strong. They don't want to tip that into, tip unemployment too high. That's what we consider a hard landing, right? You raise rates high enough to combat inflation, but now all of a sudden people are getting laid off and the economy comes to a standstill. So anyway, walking the tightrope. I'm sure they're looking at a lot of things and talking behind closed doors about stuff that we can only infer. But that's I think that the challenge is that it's not a cause and effect, immediate gratification type thing, and it's a challenge.
So we've got a question. Do you foresee any long-term shift in the global economy coming from Europe's shift away from Russian energy and China's political positions and aging population? There's some interesting news out of China just yesterday.
Great. Yeah. I mean, an aging population. I think I probably saw the same article. They were talking about India, right, being the more post-populous and growing population. Now, as I was reading that, I was thinking about Africa as well.
Mm-hmm.
I briefly mentioned frontier markets earlier. You don't see many investments in African countries because of how underdeveloped they are, but demographics are huge from an economic standpoint, especially if they're young, tech savvy, and that sort of thing. So yeah, I think the reason for the article is that, the US and China, two global economic powerhouses, have, aging and shrinking populations. Hotbed, political issue, but immigration, if we can't make people have more children for the workforce, immigration is a possible solution to that. And depending on where you live and what industry you are, there are definitely acute problems in farming. A lot of places relied on immigration to support that labor market. So absolutely. And I don't know, let me go back to the question, because that may be something you added. Long-term shift from Europe's. Yeah, so I think that's the second part of it. Political positions, absolutely. I think where we're seeing, instead of it being sort of East versus West or developed versus emerging, where we're starting to see things develop are sort of these democratic and non-democratic factions. So you have, potentially China aligning with Russia and other countries that are less concerned about freedom and democracy and things like that. And then you have the rest of the world that pays attention to that. And, talk about a tightrope, right? I mean, if the US can't just unilaterally say we're no longer going to buy anything from China without, really upsetting a lot of US consumers that don't even know how much we rely on that relationship, whether it's components in things that might be assembled in the US, whether it's just the overall price of things, that if we don't have that competition, prices get out of control. We don't have our same standard of living. So that definitely is something that is being closely monitored. There's a lot more to that than just politics and investments. Europe, so I think that's an easier one, right? The more time that passes, the more solutions come online to backfill Russian, their reliance on Russian energy. It takes a while to build an offshore, wind farm, but there's already a lot more talk about that. Just, look up, what is it? The Black Sea. They talk about these companies in places like Denmark, where they have these amazing consistent winds that could generate enough power to basically heat and light all of Europe's households, right? So, but that takes a while. Like there's political reasons, there's environmental things they need to mitigate, but ultimately there might be some short-term pain if Russia's oil is cut off, but ultimately there will be resolutions or other solutions to that.
In a microcosm, it's part of the old saw that the best cure for high gas prices is high gas prices, right? Because they make us look at the alternatives.
Absolutely. Yeah. Or it makes the energy companies pump more gas out, right?
Right. So this is a good one, because this is one that if a client asked me in a meeting, I'm gonna have to call Mario.
Yeah.
How much is the growth in strength of the dollar how much has the growth in strength of the dollar fueled the tech growth in the US over the past decade? Does that factor play significantly into where companies choose to list on an exchange?
Wow. Both tough questions.
Yeah.
To quantify the first part, I think is very difficult to do. How much of it was in hindsight and even in foresight, I think you would find a lot of economists and fundamental investors saying, look, and especially, depending on where opinions sort of sway your logic, but I would say it wasn't illogical to say that easy money probably inflated asset prices. And that stocks across the board, right? I want to make sure I clarify that it's not like value performed positively and growth performed worse. The relationship, PIMCO has a great slide that shows it sort of as a ripple effect, where assets are all going to be impacted. Some are just going to be impacted more. So trying to say this without getting too wonky, but the idea is it's kind of that the duration of your investments. If the payoff of the investment is farther off in the future, or the bulk of the value of that payoff is farther in the future, that's going to be more largely influenced by the cost of capital. So real estate investments, in particular, speculative real estate investments that have a big payoff at the end, growth stocks that have a big payoff in the future, their values are going to be much more positively influenced by cheap capital, low rates, negatively impacted by higher capital. Things that are paying you cash today, rental income, dividend stocks, bonds with decent coupons, those are going to be less impacted by changes in the cost of capital.
And
so I'd say how much? Lots. Quantifiable? Not sure.
not really.
And then does that play into where companies choose to list on an exchange? So I'm going to answer that differently. I think we are seeing and that's a great question. I'd love to dig more into where that came from. But we are seeing fewer companies listing, or another word for listing is going public and becoming publicly traded stocks. And I don't know if it has more to do with interest rates or tech growth or whatever, because it's not just tech companies that go IPO, although that's the ones you really hear the big splash about. I think we're seeing a shift in the number of companies that go public because there are a lot more options for them. There are a lot more options for getting private financing,
Equity.
private equity, private credit, banks are kind of exiting that space or have exited that space. But the other side of that is, and I think this is a positive for investing as a whole and the whole business climate. But if you think about a private company, they're a lot more long-term oriented, right? What strategic decisions are we making to benefit our shareholders over the long run versus public companies that are still have their feet to the fire over meeting quarterly earnings estimates. And I think a lot of companies would rather not have to deal with that, especially if they want to be true to their long-range plans, long-range goals. So anyway, for what it's worth, if that didn't answer the question, I repeat, feel free to follow up.
So this is interesting too. Any thoughts in particular about trajectory of entertainment stocks, maybe as related to infotech, given all the consolidations, discussions about adjustments in streaming platforms, et cetera? I like this because I think I know where you're going to go with this.
I don't know. I'm going to throw you a curveball here. So if you think that I'm inept with PowerPoint, you should see me sit down thinking I'm about ready to watch a movie and then find out it's on Paramount Plus and not Disney or one of the other things that I think I know that I have subscribed to. I think what you thought I was going to say is we don't follow individual stocks.
That's what I was expecting,
sectors.
yeah.
And that's true. But again, I'd love to hear a follow-up question. I think my answer would have been a lot more clear at the end of 2021 when Netflix and Facebook and Amazon and all those stocks were up mid double digits, 50, 60%. And it was because Netflix was adding, double-digit subscriptions every week. And you know that there's a finite number of households. And ultimately, people are going to start going back to their, baseball games and bowling leagues and whatever people did pre-COVID. And those subscriptions were going to fall off. That it was a little clearer environment then. The nuance of streaming services, consolidation, all that kind of stuff, that's outside of my expertise. But again, if there's a specific question or if you have particular insight, I'm a sponge. So I'd love to hear that. Anything else?
I think that's what we have so far. Give it another second. And I think you hit the one thing I was thinking about coming back to was how the balancing act that the Fed seems to be doing between unemployment and slowing demand. And I think you hit on that, answering one of the other questions. So darn.
All right. Well, glad to help. Wow, we took up the hour.
We
for
did.
Better or
that was
worse.
Almost perfect. Look at it. It's 5 o'clock right on the nose. Thank you as always, Mario. And folks, we've got a direct line to Mario. So if you think of things after the call, just email them to me or Nick or bring them up at a meeting, and we'll be able to pass those on. So
thanks, everybody. I really appreciate it.
great.
Happy to take feedback, positive, negative, or any questions that come up afterward. We want to make sure we leave no stone unturned.
Thanks, Mario. This is great.
Thanks, folks.